Today, we're going to talk about what could be one of the most important metrics in your business. And it's so important because it can drastically impact the amount of cash that you have at your disposal. Today, we're going to talk about the cash conversion cycle, what it is, and how you as a business owner can use it to your advantage. When we talk about cash or the cash conversion cycle in a business, I like to think about it in a loop. You start a business with cash, and your ultimate goal is to create more cash from that business. So, our loop starts with the idea of cash. And then you add the cycles of cash going out, you paying for things, and then cash coming in from the revenue collected. The first element is paying money to then eventually convert into revenue. For product businesses, this is going to be inventory. For service businesses, this could be paying for the service, the people, whatever's related to that service. So you pay for that inventory that is cash going out of the business. That is an accounts payable. So sometimes you'll have to pay that money up front. Other times you'll get a term to pay that. So you have cash being committed to the inventory or to the payable, and then that is cash going out. Now you have to get paid back. So you eventually make a sale. When you make a sale, that sale generates an accounts receivable or a promise that you're going to get paid in the future. Again, sometimes you can get paid immediately. Sometimes you will pay immediately on accounts payable. But ultimately, we have all elements of this cycle. And every business cycle is different. Sometimes in service businesses, you have arrangements that are pay when paid, meaning you don't have to pay the contractor or the person doing the work until you have been paid by your customer. Other times you're going to have payroll. And so that payroll march is going to come and it's going to happen time and time again, no matter what happens with your sales. But if we think about this in the connected nature of that initial cash covering the initial cost of the product or service, then getting paid to then fulfill, that should be more cash coming in on the backside. That cash can be used for all sorts of things. We talk about that in other videos. You'll have to go look for those. I'll link one of those up here as well. This movement of cash is what we call the cash conversion cycle. And the idea is we want to answer the question, how long is it between the initial cash outlay and the money coming in from the sale? And that number is a telltale sign of how well you're going to be able to fund growth within your business. When we break this into a definition, the cash conversion cycle is 3 elements. It's taking days inventory outstanding. How many days does it take you to convert inventory into a sale? Plus days receivable outstanding. So how many days does it take you to collect from when you made the sale? Minus days payable outstanding. So the term on which you paid for that inventory. This is a product focused number, but you can also convert this for service businesses. We're not going to talk about that here today, but know that you can do that and you can get a very similar number by replacing that inventory from payroll, from contractors, whatever that may look like for you. So as we dig into this cash conversion cycle, talking about what does it mean days inventory outstanding? You'll take your average inventory balance over the period that you're looking at. So that could be a year, that could be a month, whatever that is, divided by your cost of goods sold times the days in that period. So if you have a balance of $1 million, cost of goods sold of say 300,000, you take $1 million divided by 300,000, that's a third times 30 days. If it's a 30-day period, you would have 100 days of inventory outstanding. That 100 days means that from when you have that first outlay, you're on average holding inventory for 100 days. Days sales outstanding is the next piece of that pie. And this is looking at your accounts receivable balance for the period you're trying to analyze dividing it by your revenue, multiplying it by the days in that period. That's going to tell you how long on average does it take you to collect the money from the sale. If you collect money on day 0, then that can be 0. If you collect money at 30 days, that could be 30 or 40 days. As you have people go over terms, that number can creep up, and we want to keep that number as low as possible. There's ways to manipulate this number. There's ways to improve this number no matter what situation you're in. We're not going to get into that today. Again, this is a foundation that we're setting, but we will for sure talk about that at other points. The third element is the days payable outstanding. This is the average accounts payable balance over the period that you're looking at, divided by cost of goods sold, multiplied by days in the period. When you take that whole formula, you see that when you get to the end, you're saying how much from the initial commitment of inventory to the cash outlay related to it, to receiving the cash from the sale of that product. What is the cycle of that dollar? The faster you can make that cycle, the more quickly you're going to be able to grow your business. This cycle continues. And as cash is generated from sale, it goes back into inventory. But if you get to the end and you don't have enough cash to reinvest, then that is where you find problems. I find the best way to go about this and how we can actually manipulate these numbers is to actually go through an example. So I'm going to go through an example of a business that BisonCFO, the company that I started, worked with this business to improve their cash conversion cycle. When we first started working with them, we came in and we realized that it was taking them 200 days from ordering inventory to selling that piece of inventory. This meant that they didn't even have one full inventory turn in a year. The main culprit was that it was taking them 185 days from order to receiving to where they could actually sell that inventory. So they were getting their inventory from overseas. It was taking a long time for that to come via boat to their warehouses. So they had 185 days from order to getting in the warehouse, and then 15 days from in the warehouse to selling to the customer and then collecting that payment. So that days inventory outstanding for them was 200 days. This meant that as they grew, they were really constrained by this 200 days. We'll talk about that in a second. The next element is the days receivable outstanding. So for some, they collected payment on day 1 when they made the sale. For others, they gave them terms. On average, they were doing a bad job of collecting the term payments. So even though they collected some on day 0, immediately when the sale happened, their average receivables outstanding was still above 30 days. So I've rounded this to 30 days just to make it nice and easy. Days payable outstanding was 0, meaning they had to pay for the inventory the day they committed to getting that inventory. So they got no credit for that 185 days, for the 15 days. They had to pay it, then wait 185 days to even be able to sell it, and then wait 15 days for it to sell through, and then sometimes even wait another 30 days to actually collect that cash from the customer. That meant that their cash conversion cycle, if we take 200 days for the inventory plus the 30 days for accounts receivable minus the payable days, you have 230-day cash conversion cycle. That meant it took them from the initial outlay to then reordering 11 months to get cash flow positive on that first order. So that means they had to have enough cash in the bank account before that first order to be able to pay for 11 months of orders. Only then could they start paying themselves, could they start actually reinvesting the new cash into that cycle. That meant because of that outlay, they had to pay out $235,000 before they even got a dollar back in, because that 230-day cycle, really that 200 inventory outstanding days cycle. So what did we do? Well, we had to look at the levers that we had available to us. So we asked them, what is your relationship with that supplier? When they went to that supplier, they expressed the difficulty they were having. They actually found that there was a different way that they could get their inventory. That meant they took that shipping days from 185 days to 15 days. That was, in and of itself, transformational. But then to add to that, they still had 15 days to sell it. So that means that their days inventory outstanding was 30 days in total. The next element that we looked at was their days receivable outstanding. Again, some were on terms, some were not, but because they weren't collecting, it was taking them on average 30 days. We talked about implementing some systems to do some more frequent follow-up, to force people that they did not have credit terms with to do the payment immediately. We didn't make for this scenario an adjustment, but over a 6-month period, we were able to get their days receivable outstanding from about 35 days all the way down to 20 days. And that change made a significant impact on the amount of bad debt that they actually had from not collecting from people that they didn't have long-term relationships with. The last piece is this days payable outstanding. The days payable outstanding, they got a huge win as well. The new supplier did not make them pay until it arrived and was available for them to sell. So that 15-day shipping period, they did not have to pay until it was in their warehouse. So that meant that they got 15 days credit back in this cycle. So they were able to take their cash conversion cycle from 230 days to 45 days, which meant that their cash positive happened in month 2, meaning they can start investing that money back in inventory, back in growing the business. That meant that they only needed $67,000 before starting the business instead of $235,000. This business had all sorts of issues initially. They kept having tax payments, things coming up, and they didn't have the cash in the bank, always feeling like they were drowning because it was a growing business that was eating all their cash. By improving this cycle for them, we were able to transform their relationship with that money. The business owner was able to start taking distributions without any additional profit because they were able to speed up that cycle. They were able to grow more freely without as many issues. For you, I want you to take action now. I want you to go calculate your cash conversion cycle. Look at those variables from your income statement and balance sheet, take the averages, figure out your number, and even go back, put it on a spreadsheet and look at the last year, 2 years, 3 years, whatever data you have, see how it has changed. We have seen time and time again that when things get hard for businesses, when the economy changes, we can see changes in this cash conversion cycle before the owner even feels anything. It's a good leading metric for us as we evaluate businesses. Second, pick whichever one is worst for you and brainstorm your options and how you can change it. Can you work on terms with vendors? Can you work on terms with customers? Can you work on slowing down payments in an ethical way? If you can brainstorm those options, you should be able to come up with 1 or 2 things that you can do today. And then in 90 days, report back, circle back, see how it's changed, see how it's improved or not improved, and continue to iterate and look for ways to change your cash conversion cycle. Get it from that 230-day period back to 45 days. I'd even challenge some of you. Some businesses can do a negative cash conversion cycle, meaning they collect the money before any outflow ever happens. That creates a business that can grow infinitely with no stress other than the stress of fulfilling of what you're promising, but removing the stress from growth related to scaling that particular offer. If you want to go deeper, you want to learn these concepts even more, I encourage you, join my cohort. We're about to start one. If you're watching this as this releases, we're starting one next week. We'll continue to do these every few months. So even if you're after that, you can still join. I want to help you in a week period, increase your profits and get more cash in your pockets. If that's something that interests you, the link to this cohort will be in the description. Thank you for watching, and until next time, keep hold of your cash.